To add to what Rick said, I think one of the driving forces of the current cycle is, as he was referring to, capital. Capital has allowed to emancipate hotels amongst other asset classes more than ever before. Because when I started working in fund management hotels like 16 years ago. In those days, a fund manager, a pension fund manager, who would manage 30 billion, 50 billion, and was in the institutional side, so he was regulated, called Deutsche Bank, Goldman Sachs, or Morgan Stanley, whatever, and buy 500 million of government bonds and get 5-6% for that. And he would make one phone call and basically then go home. Because what he had to do is he had to generate 4% or 3% on his total portfolio, and all he had to do is buy 10-year government bonds. Today, let's try that again. And in Germany, that is probably minus 5 basis points or 10 basis points negative. So these guys have an issue because they still have to pay the 3 and 4%. And that leads them to alternative investment asset classes. And that is one of the driving forces of why people now invest in hotels. Between 2012 and 2015, hotel investment has quadrupled in Europe. Actually more than quadrupled. And that is driven by that. Nobody is fallen in love with hotels. It's born out of need. That's why also other asset classes that are income generating, have become more and more in favor. Now that means for people like us, you see, I started at Internos with zero because I set up the hotel and leisure division. And we then had, after about 18 months, 75 million equity. Today we have roughly 500 million of equity in hotel and leisure. And people are gagging for it, literally. Why? Because we are generating 7-8% running returns. That actually has led, however, to an overpricing of markets. When you look at transactions in some countries, like in particular the core Eurozone zones, so for instance, Germany is a classic example, yields have come down by 350 basis points, 250, 350. What does it mean? Coming to your initial question, sorry to have such a wide introduction to my answer, means that today, since markets overheated, we have to find value. We have to find value where it's more difficult than the same thing like the pension fund manager. I could buy a 20-year leased hotel for 7% or 7.5% 5, 6, 7 years ago, no more today. So if I want to generate similar returns, I have to do something different. So we actually go now after value add strategies, and that means we do all sorts of things at the asset level, at the operating level, at the lease contract level, at various levels to create value. And that is essentially the element of our investment strategy. One of the interesting things is also that we start actually looking for the first time now over the last 2-3 years at resort hotels. But not if it's just a resort, but if it's a residential angle, has a residential angle. But the same way, like in New York, obviously you can't compare Ibiza with New York, but if we have a residential angle, so that we have liquidity of our investment by selling whatever 50 apartments or villa, and effectively we keep a 80-room boutique luxury hotel as a freebie after we've sold the apartments, then we have made a good investment. So we look selectively also at stuff like this, to the extent that we're actually making an investment in residential, where the liquidity, because I'm very comfortable of selling luxury apartments or villas in Ibiza, Mallorca, or whatever major infrastructure tourist destination to French, English, German, whatever wealthy clients, because that market will always be there. So that is an alternative. So we as well, we have to find new ways to actually lead institutional investors into something which still has to have a manageable risk profile and can't be purely private equity.
Okay.